Stocks just hit a record high for the third time in 4 days as momentum is picking up. We got the big beautiful bill passing the House, trade deals happening, mixed economic data, and whispers of possible Fed cuts. It's all bullish on the surface, but there are cracks starting to show, so let's find out how everything is going. So overall today, the stock market was pretty optimistic based on all of the news that was going on. They powered up today before the extended weekend for the 4th of July. Stock market is closed tomorrow. We got higher highs for the S&P 500, higher highs for the NASDAQ, and this is the third time in 4 days as just mentioned. And this is right as we're heading into July, which July has been historically known for the best performing month over the past 20 years. And it seems like the worst case scenario is really fading away as the economy is currently holding up with this cooling inflation and apparently good data coming out. So the good news is spreading over to the momentum sectors. We got high beta stocks, small caps, these momentum plays, mainly your risk on plays doing well. We got Bitcoin up on the day, like I said, the NASDAQ, the S&P 500, and they just keep on like hugging this 50-day moving average. It looks like Bitcoin's 50-day and the 200-day tried to cross over, but today's data and news that we got really helped it breach that from happening. We also have a falling VIX where it's historically near its lows. And usually low volatility doesn't last forever. But as we keep on heading higher, investors are really watching a few things. Mainly this 90-day tariff pause. So far we have 2 deals, and that deadline is on July 9th when that pause is expected to end from that 10-day reduction walk back. And so far what we got is the UK trade deal. And then we got Vietnam. And this article right here, Trump's Vietnam trade deal, is all about China, what that means for markets. And they pretty much go in to talk about how this Vietnam trade deal is great, but it looks like more of a maneuver to box in China and try to get them as far as a deal happening with them. The deal is unlikely to substantially reduce the U.S. trade deficit with Vietnam, which stood at more than $123 billion last year. It's hard to imagine that it will lead to significant sales of SUVs, and this is coming from a country that still relies on motorcycles rather than cars. And the new tariff level also isn't as high enough penalty to shift clothing manufacturing stateside. So it's really up in the air whether or not this was a successful deal or not, but it contains a 40% tax applied to goods shipped via Vietnam from third countries that transshipping, a key measure and one squarely aimed at China. And there's plenty of reason to clamp down on such shipments, with up to 28% of Vietnam's exports to the U.S. containing indirect Chinese content. So that's a 40% tariff if they go through there. And some people are thinking that, hey, like, this kind of puts China in a corner because right now, like, between the negotiations, China kind of seems to have that upper hand and the deals just aren't being made. We haven't heard much news from a president who seems to tweet or truth about literally everything. We haven't heard much about China's negotiations yet. So we'll keep on watching this. Maybe this deal with Vietnam gets this deal moving with China, but that's all up in the air. We also have the European Union, who is aiming for a trade agreement in principle with the Trump administration rather than a more comprehensive deal by July 9th. So I'd imagine this is just kind of like, hey, let's get this starting point, kind of like that July 9th thing. Like, hey, let's get to this starting point and negotiate. So they're pulling the Trump tactic on Trump. We'll see how that goes, but the European Commission president said Thursday that reaching a detailed agreement with the U.S. during the Trump administration's 90-day window wasn't possible. Negotiating with the U.S. is a huge task because of the volume and complexity of the trade relationship. What we are aiming at is an agreement in principle. So we'll see what happens with this one, but it seems like these 2 deals are all we're going to get by July 9th. I mean, technically we still got 9 days, really 8 if you count Thursday as a dub and done and over with. So that leaves 4th of July. Probably nothing's going to happen on that day. So really, like, let's say 7 days. So 7 days to make something happen. Who knows if it happens or not? There's a lot of countries. We're really looking at China and the European Union, and it's all up in the air whether or not anything happens. Now, as far as the stock market that just keeps on reaching higher highs, there's another thing that investors are watching, which is earnings season, and the popular belief is that big tech will come through and really impress with great numbers and raise guidance due to AI investment. Also the labor market, but we'll get into all that a little bit later. But let's go back to this saying that we all know. Time in the market beats timing the market. And we all are reminded that as we're continued up this ladder, as these stocks reach new all-time highs after new all-time highs, as this uncertainty hasn't really disappeared, it's still looming. And this article right here by Steven Sears, titled "Don't Try to Time the Market, Use This Option Strategy Instead," really starts off saying, hey, dollar cost average into these blue chip stocks, they tend to rise over time. Like the S&P 500, for example. And over a long period of time, let your gains compound and they'll do good. And over a long period of time, you can outperform some of these fund managers. So buy during the good and the bad and tune out all of the short-term noise. Just ignore it and continue to dollar cost average. And then maybe like during times of dips, be prepared to buy that and maybe even buy more during those dips. But maybe don't like go all cash, don't sell all your stocks, don't try to time the market. And then they go into another option, which would be options. And the options strategy that they really point out is selling a put option, which the puts give the holder the right to sell an asset at a set price. So in order, when you sell a put option, pretty much the put buyer is paying the writer or the person selling this put a premium. And they're saying, hey, with the S&P 500 at, let's say, this 620 mark, sell the August. So they're saying go out on August's option chain, sell the 590 put option for about $423, and the August 580 put option for about $316. And you'll get the premium of the $316, the $423, and assuming that the ETF, the S&P 500 holds above the put strikes at expiration, then investors will keep the premium, which is a nice amount for agreeing to buy stocks at a lower price. And then they go on to say if the ETF falls below one or both of these put strikes at expiration, investors should just buy the ETF. But the risk is that it could fall in the short term more than the put strike prices. So you might have to buy at 580 and somehow it's at like 420, for example. I'm not saying that's going to happen, but that's just kind of what this is talking about. Now, options are a little bit more to deal with. So don't sign yourself up for something you're not comfortable with doing. There's a lot more complexities that go into options, but I just thought it was interesting that they're bringing this up and recommending this to people. So do what you will with this information. This is not a recommendation. I don't know what the heck I'm talking about. I'm just a guy on YouTube. Now, we also got jobs, and this one was huge. So we were watching from the Bureau of Labor Statistics for job gains around 110 to, let's say, 115,000 jobs to be added in the month of June. And what we got was a beat. So that 110, 115 came out to 147,000 jobs in June. So this was a huge beat for new hires. Plus the revisions for prior months were a lot stronger than previously thought. So the labor market's looking pretty good. At first thought, I was thinking, maybe this is just employers feeling good due to tariffs having smaller than expected impacts on their businesses and what's ahead of us. Q3, Q4, shopping season, holidays coming up, so they might want a little bit of help. But a closer look at this revealed that half of the jobs created were state and local government jobs, while the private sector added the fewest new workers in 8 months. And back to the local government and state government jobs, mainly all of that was concentrated in education. Now, the private sector only added 74,000 jobs, down from 137,000 in May. So that's quite the drop off. And almost all were in the healthcare industry, which private healthcare jobs are vulnerable to healthcare spending cuts that are part of Trump's tax and spending bill. So keep watching that. And then other than the healthcare industry, most other industries weren't hiring, and consumers continue to want to save, and spending at bars and restaurants and entertainment. If there's any further cracks in the economy or slowdown or a shock or a scare, there could be more caution in spending, causing more widespread contagion in these other industries. The unemployment rate was, which was expected to come in an increase from this 4.2 figure in May to 4.3% in June. What it actually came out to was 4.1%. So it actually went down despite all of the expectation of it slightly increasing. And that was low-key a shocker. And this was due to 329,000 people deciding to just completely quit and drop out of the labor force because of what they say is it's hard to find a job for, which has been a trend right now. Companies just aren't hiring. They're just keeping. There's not a lot of layoffs. But as far as new hires, companies aren't making that investment right now. We've seen the participation rate, which tells what share of people of working age, either who have a job or are looking for a job, that fell to a 2.5-year low of 62.3%, down from the post-pandemic peak of 62.8%. I mean, down is down, but that's not a huge down, 0.5%, but every little bit counts, especially when the labor market's what a lot of people are watching, that and inflation. So participation may continue to trend down as the immigration crackdown has continued to impact the supply of workers. Also, as far as workers' pay, that has slowed to 3.7% in June. Workers' pay increases, since employers have a lot more leverage now than they did during the pandemic, when they just couldn't seem to get enough help. Right now, they're just not hiring. So during the time they couldn't get a lot of help, wage growth was as high as 6% a year. And right now they have more leverage. So that explains the almost cut in half in wage growth that we've seen. And let's look at some responses. Here we got David Rosenberg's response. This was a weak employment report. Connor Smith posted it here on Barron's. And what David Rosenberg had to say is the initial market reaction only tells me that investors and traders have yet to conduct any real analysis on this report, because it's far weaker than the headline suggested. Hopefully, the economics staff at the Fed will be combing through the report and advising FOMC officials as such. So he's probably pulling more at a cut and saying, hey, all of these rookie investors who've seen the headline number, jobs beat, buy the dip, well, continue buying stocks and continue pushing them up because of that jobs number coming out good. He's saying, hey, they just seen the headline number. They didn't look at the report and go into detail. The private sector's kind of struggling. The Fed might need to cut rates. And this was not a strong report at all, not by a country mile, Rosenberg writes. When you strip out this skew, private sector jobs actually declined fractionally. That is the major takeaway in this report. This emboldens, not detracts from the recession call. So he's saying this makes recession risk even more. Virtually all of the headline job gain came from two sectors that have nothing to do with the economic cycle: state, local government, and health, education, social services. The other 2/3 of the labor market basically stagnated. But look at this. So, like, the headline number was good, and then we got this stagnating other 2/3 of the labor market, and he's the first guy that I seen to complain about it. Look at this. UPS offers buyouts to drivers, a first in its 117-year history, by Esther Fung. The United Parcel Service is offering buyouts to delivery drivers for the first time in its 117-year history. The company is seeking cost savings because of stagnant parcel volumes, rising labor costs, and a long slump in the company's stock price. So they're really trying to save money. UPS employs around 330,000 full-time and part-time delivery drivers, clerks, and package handlers. Full-time drivers are eligible for a buyout, the company said. UPS and the union declined to say how many full-time drivers UPS employs. UPS drivers are among the highest paid delivery drivers in the US. The average full-time driver will earn about $170,000 annually, including benefits. So here's another company really trying to ease off, like they're not announcing layoffs, instead they're trying to buy out their drivers. So I wonder what that means. But now let's look at all of this through the lens of the Fed, from the Fed's point of view. So it's likely the headline number, it's seen as super positive, like we said, for anybody not really looking at the report or going through it, they're just looking at the headline number. From the Fed's perspective, this will justify them to really wait and see, since the labor market is holding up. But let's see what the probabilities are for July now. Yep. So any chances of a cut in July completely fell off of a cliff based on this. 95.3% chance that rates stay the same. What about September? I'm interested to see. Okay, this one didn't move too much. I mean, we're around 70 last week. I think we even crossed over 70 briefly, and now we're sitting at 64 for a cut of 25 basis points, or 0.25%. In September 17th's meeting. So we'll continue watching this and seeing how it moves, because the data, all of these numbers and probabilities and expectations continue to move as more Fed speak, company earnings, economic data sets, Trump, trade wars, Iran and Israel. Any of that can move the needle regarding all of this. We had Atlanta Fed President Raphael Bostic come out, and he made his points aware. And really what he said out in Germany today is that he doesn't really see signs of serious weakening in the labor market, and supports waiting and seeing while he also sees inflation continuing to be a problem from tariffs. But overall, the economy's good for now, and that he wants to continue watching to see what really happens, is what we got from that. And then we also got the Institute of Supply Management, the ISM data out today. And the service side of the economy, which makes up about 70% of US GDP, rebounded in June with the ISM Services Index, which rose 49.9% in May to 50.8%. So we went from barely contracting to economic expansion in June, signaling expansion but not regaining the momentum it lost after Trump tariffs became a reality during the Liberation Day announcement. Some of the details from the report show that the production gauge jumped 4.2 points to 54.2%. New orders index rose to 51.3%. The employment barometer fell to 47.2%. So remember, under 50s contracting. Prices paid index fell to 67.5%. So, I mean, overall, this was a good report. Now, the news doesn't just end there. We got a big one with the big, beautiful bill passes the House and is right on track for Trump's goal of being signed into law by the 4th of July. So let's read into this one. The House voted 218 to 214 to pass the bill, and really what this does is it now heads to the Oval Office, where Trump is expected to swiftly sign the bill into law. And some of the details: the bill extends the 2017 tax cuts originally passed by Trump's first term. Among other provisions, the Senate version of the bill increased the cap on state and local tax deductions to $40,000 from $10,000, and reinstated the cap to $10,000 in 2030. The Senate also made permanent tax breaks for research and development, business interest, and some investments that the White House had set up to expire in 2029, but limited the tax breaks for tips and overtime, a major Trump campaign promise. On the spending side of the bill, the Senate bill would put in place a 3.5% cap on so-called provider taxes that states use to finance their Medicaid programs, a move that GOP moderates fear could throw hundreds of thousands of people off health care and hurt rural hospitals. The Senate also slowed the phase out of some green energy tax breaks originally created by Joe Biden's Inflation Reduction Act. Overall, the Senate bill would add about $3.4 trillion to the federal debt over the next decade, according to the Congressional Budget Office, compared to the $2.8 trillion that the House version was projected to add. So this one's a huge one because this is kind of the whole thing Trump's been talking about. Hey, it's going to be great, best economy ever, make America great again. We're going to do this, and that. So it finally passed, and it seems like it's going to pass right on time. And a big one with that was the tariff revenue. So it's back to whether or not these tariffs are illegal or if they're allowed. And if they're illegal, will Trump try to loophole around and get the revenue from some other way or source? So we'll keep on watching that. But that's what 4th of July is, what I'm expecting to happen on 4th of July is that announcement. And speaking of the 4th of July, it's expected to be more expensive overall with tariffs impacting firework costs. But what else could cost more during the 4th of July? Well, according to Mariah Gonzalez, your July 4th burgers will be pricey. Maybe grilled pork chops instead. So this year, total spending for 4th of July festivities dropped 5.3% from last year to $8.9 billion, according to a survey data from the National Retail Federation. Of the people surveyed, 61% will participate in cookouts, picnics, and barbecues, which is down 5% from last year. The average price of ground beef rose 11.5% to $6.25 a pound in May from a year earlier. According to the CPI data that we got from the BLS, the average monthly price of ground beef has shot up 31% since 2020 based on 2025 data through May. So, yeah, beef is expected to cost more as well as your fireworks this year. I wonder if this coincides with the data and how the consumer's doing and everything. Just another expense, another way to get more money out of you. And what's my personal favorite thing about 4th of July, because I don't really like hot dogs, it's the burgers. And the burgers are the most expensive part. Shoot, it's almost like brisket and ribs. Like, burgers are considered a luxury now. So what do we got next? Happy 4th of July, by the way. What we're going to be watching next is Monday. Monday is going to be a super quiet day. On Tuesday, we got some treasury auctions for the 3-year and the 10-year treasury auction. So a lot of bond investors and mortgage loan officers, a lot of people will be watching that because treasuries impact borrowing costs back to think your 30-year mortgage. A lot of that's dependent on how the 10-year treasury moves. So Tuesday we got the treasury auctions, we got the NFIB business optimism index, consumer credit. So we'll see how that comes in. Wednesday we got wholesale inventories, the Fed minutes for May. So a lot of people will be watching that one. So highlight that, even though that's more backwards looking and not so much forward looking, but a lot of people will pay close detail to that. Thursday, we got initial jobless claims. That one is big. We got some Fed speakers. Also Thursday, we got the 30-year treasury auction. Are we getting demand or is it slowing down from our international buyers? And then Friday, we got the monthly U.S. federal budget. So that's what to look forward to next week. So yes, the market is continuing to rally, and that's worth a nod or two, but with structural risks building off screen, today's gains may not be tomorrow's signal. So keep tracking these earnings, watch those labor numbers because that impacts how the Fed will move, and watch those Fed moves because this run could flip fast if any of the popular themes continue to or start showing more signs of breakage. Stay sharp, stay coming back to hang out with me while we learn about what's going on, and thank you for being here, everybody. Happy 4th of July. Hope you're safe and have a good one. We'll see you.